In October 1907, the United States stood on the edge of financial collapse. There was no Federal Reserve, no central authority to inject liquidity, no coordinated emergency response. The banking system depended on trust, and trust was evaporating. It started quietly. A failed attempt to corner the stock of United Copper Company triggered a chain reaction. When the speculation collapsed, banks connected to the shame began to wobble. Depositors grew nervous, and nervous depositors do one thing: they withdraw. At the time, banks did not hold enough cash to satisfy mass withdrawals. They relied on the interbank lending, money flowing quietly between institutions. But once fear entered the system, banks stopped lending to each other. Liquidity froze. When Knickerbocker Trust Company, one of New York's largest trust companies, faced a run-cross lineup outside its doors, within hours it was finished. The collapse sent shockwaves through New York. Trust companies were less regulated than banks, and now they looked dangerously fragile. The panic spread beyond New York. Stock prices plummeted. Factories feared payroll failures. Business could not secure loans. America was industrializing rapidly. Railroads, steel, oil, and all of it relied on credit. And credit was disappearing. The United States Treasury tried to inject funds, but without a central bank, coordination was chaotic. There was no structured mechanism to stop contagion. The system was decentralized. As panic intensified, attention turned to one man, John Piermont Morgan. Morgan was 70 old in 1907. He was not an elected official. He held no public office. Yet, he controlled immense financial influence through his banking empire. Morgan had already stabilized markets before, but this time was different. This time, the entire system was shaking. He understood one thing clearly: if confidence was not restored immediately, the collapse could spread nationwide. Morgan did something extraordinary. He summoned New York's most powerful bankers to his private library. Heavy wooden doors closed behind them. They would not leave until a solution was found. Morgan demanded transparency. He ordered bankers to open their books. He assessed which institutions were solvent and which were beyond saving. Emotion had no place in the room. This was mathematics, cold and decisive. One by one, Morgan organized rescue packages. Healthy banks would support weaker ones. Funds would be pooled. Liquidity would be strategically disrupted. It was not charity. It was self-preservation. If one major institution failed, all could fail. Morgan even personally pledged millions of dollars to stabilize markets. Newspapers the next morning reported coordinated action. Public confidence shifted silently, not restored but stabilized. One by one, Morgan organized rescue packets. Healthy banks would support weaker ones. Funds would be pooled. Liquidity would be strategically disrupted. It was not charity, it was self-preservation. If one major institution failed, all could fail. Morgan even personally pledged millions of dollars to stabilize markets. Newspapers the next morning reported coordination action. Public confidence shifted slightly, not restored but stabilized. But the crisis was not over. The New York Stock Exchange itself was in danger. call money rates, short-term loans to brokers spiked to 70%. Without invitation, trading cooled out. Morgan gathered leading financiers again. They pledged $25 million to stabilize the exchange. That single act prevented closure. Imagine if Wall Street had shut down completely. The physiological damage alone could have been catastrophic. By November, the worst had passed. Markets stabilized, withdrawals slowed, production resumed. Morgan had prevented systemic collapse, but the question lingered. Should a nation's financial survival depend on one private individual? The panic of 1907 exposed a structural weakness. America needed a lender of last resort, a permanent solution, something institutional, something public. That debate would reshape the nation, and it would lead directly to 1913. The panic of 1907 had ended, but the fear had not. In Washington, lawmakers understood something uncomfortable. If Morgan had failed, the United States might have entered a full economic depression years before 1929. One private banker had stabilized the nation. That was not a system, that was improvisation. America needed structure. It needed a lender of last resort. But how do you build a central bank in a country that deeply distrusts centralized power? For decades, Americans had resisted the idea of central bank. First Bank of the United States had expired. The second bank had been dismantled under Andrew Jackson. Central banking was associated with elite control. European-style financial power, many feared it would give Wall Street too much influence. But 1907 changed the conversation. Now the question was not ideological, it was practical. How do we prevent panic from destroying the economy again? One senator became central to the reform effort. Nelson Aldrich, chairman of the National Monetary Commission. He studied European banking systems, Germany, France, Britain. They all had central banks. They all had mechanisms to inject liquidity during crisis. America had none. Aldrich believed reform was necessary, but he also understood something else. Public opinion would resist anything to build a central bank. So the solution had to be crafted carefully. The core idea was simple. Create a central institution that could provide emergency liquidity, stabilize banking reserves, prevent cascading collapse, act as lender of last resort. But the structure had to look decentralized. Rational banks, distribute authority, public oversight, private participation. It was a political compromise, balance power between Wall Street and Washington, at least in theory. The plan did not immediately become law. It faced criticism. Some believed it gave too much control to private bankers. Others believed it did not give enough power to government. Reform required timing and politics. In 1912, Woodrow Wilson was elected president. Financial reform became a part of his platform. Momentum returned. The Aldrich plan was modified, negotiated, reshaped, and renamed. In December in 1930, the Federal Reserve Act was signed into law. The United States finally had a central bank, but not in the traditional European sense. It was structured with 12 regional federal reserve banks overseen by a central board in Washington. Public and private elements intertwined, a hybrid model. The goal was stability. The lesson of 1907 institutionalized. The Federal Reserve was created to prevent panic, to prevent another 1907, to ensure that no single private banker will ever again have to rescue the nation. But history rarely unfolds exactly as planned. In 1929, the stock market collapsed. The Great Depression followed, and critics argued that the Federal Reserve failed its first true tests. Instead of aggressively expanding liquidity, the Fed allowed the money supply to contract. Banks failed, unemployment surged, confidence disappeared again. The very institution designed to prevent collapse stood at the center of the storm. This raised a profound question. Was the problem the existence of a central bank or the decisions made by the people running it? Because institutions do not act, people do. The Federal Reserve had power. The power depends on judgment, and judgment depends on humans' choices under pressure. The Great Depression reshaped how the Fed operated. Its mandate evolved, its tools expanded, its authority depended over time. It became the most influential central bank in the world. Fast forward to 2008, a different kind of panic. Not trust companies this time, but mortgage-backed securities. Lehman Brothers collapsed, credit markets froze, liquidity vanished again. It looked familiar. Different instruments, same fear. But unlike 1907, one private banker did not gather elites in a library. The Federal Reserve stepped in. The Fed cut interest rates aggressively. It launched quantitative easing. It purchased massive amounts of financial assets. It expanded its balance sheet to unprecedented levels. Some called it necessary, others called it dangerous, but the collapse of the system was avoided. Once again, panic was contained, but the scale of intervention was historic. Money creation reached levels unimaginable in 1907 and then became 1920. A global pandemic, economic shutdowns, supply chain disruption, markets crashed. The Federal Reserve responded faster than ever before. Trillions injected, rates slashed to zero, liquidity everywhere. The system stabilized, but inflation followed. Once again, debate ignited. Is stability worth long-term costs? Is intervention projection or distortion? When you look back at 1907, something becomes clear. The United States moved from private crisis management to institutionalized monetary power, from one man in library to a permanent central authority. The goal was stability. The result was influence. The Federal Reserve now shapes interest rates, credit conditions, asset prices, employment levels, inflation expectations, global capital flows. No single banker could ever match that scale of impact. But here is the uncomfortable truth. Power did not disappear, it transformed. In 1907, it was concentrated in one private individual. Today, it is concentrated at committee, the Federal Open Markets Committee. Decisions made in closed meetings, minutes released later, markets reacting instantly. The difference is structure, not influence. Trust remains the foundation and trust remains fragile. So, was Morgan a hero or was he a warning? Was the panic of 1907 proof that private power is dangerous or proof that decisive leadership prevents disaster? And is the Federal Reserve a safeguard or simply a more complex version of concentrated authority? History rarely offers clean answers, but it offers patterns. Fear spreads quickly, trust disappears silently, liquidity determines survival, and always someone must decide. In 1907, that decision was made in a private library. In 1913, it was formalized in law in 2008 and 2020, it was executed through modern monetary tools. Different eras. Some underlying question: who controls the system when fear takes over? And more importantly, who controls the dollar? Because money is not just paper, it is trust, it is belief, it is collective confidence in a system. When trust holds, economies function. When trust breaks, panic begins. In 1907, trust almost shattered. One man took control and the nation decided never to rely on one man again. Instead, it built an institution that still shapes your financial reality today. If you found this story powerful, if it changed how you see financial stability, take a moment to like the video. It helps this channel reach more people who want to understand money and power. And subscribe to channel for more real stories about the decisions that shape our financial world. Now, I want to hear from you. Was the most critical moment in this story Morgan's invitation in 1907, or was it the creation of the Federal Reserve in 1913? Do you think centralized power makes the system safer or more fragile? And if 1907 happened today, would we respond differently? Write your thoughts in the comments, because money survives only where trust does. This is Money Power History.